Welcome to the Diff with John Reilly and Greg Bordelon here on the Primary Vision Network, an Energy PM's take on the world of energy investing. Here we are. We're recording on June 6th, Tuesday morning. After a very busy OPEC weekend, we got another OPEC production cut, a surprise Saudi lollipop of 1 million barrels a day. In July from KSA, there was some horse trading involved between West African nations and UAE. That's been beaten to death by most major media outlets, so we won't do that for you here. I think a lot of what we discussed last week regarding OPEC's decision as being more determinant of a time frame as opposed to the outcome will still hold, and we're going to discuss that shortly. OPEC, obviously, this is their second cut. April 1, now here we are, beginning of June, they're cutting again. Certainly does not speak to a strong demand picture, and it also may be a result of some supply growth outside of OPEC that they are dealing with. Greg, what are your thoughts here? Obviously, there's two sides to every coin. There's supply and demand, and the market, especially during an OPEC weekend, spends a ton of time on supply because that's the lever. How much oil are they going to put in the market? And the rest of us have to deal with how much they're going to buy. So what was and what do you think will be the supply picture that OPEC is dealing with? And specifically, what are your thoughts outside of OPEC as they wrestle with what is obviously a slowing demand picture versus potentially growing supply in places like Guyana, Brazil, and in the U.S.?
Yeah, you're right. That the attention tends to go straight towards the OPEC consortium when they're taking supply offline. But I know you and I love to look at both sides of the equation, especially when you're looking broader than OPEC. So I went and I grabbed some data to see what the global supply picture was outside of OPEC this year. And it's worthy of discussion here. So I did kind of a screen on countries that had supply movements greater than 100,000 barrels a day year on year so far in 2023. And there's one that had supply down more than 100,000 barrels a day. That's Russia, down 200,000. And that is the most, call it bullish in that you have lower supply. That's the most bullish producer you have in 23. Mm-hmm. Now on supply growth, there are a number of regions up over 100,000 barrels a day. And I'll start from the bottom, work my way up. You have China, which I hadn't even thought of. China's up 100,000 plus barrels a day.
Yeah, they produce. People forget
they do. They produce a few million barrels a day. Yeah. And it's not rapidly declining as it seems. No. You got Norway up on the list. I'm going to say Johan Sverdrup coming up and contributing.
More to come. Sverdrup has more to come. They just tested it at an all-time high a month or two ago.
That's right. It's a big field getting bigger. So you got a couple 100,000 barrels a day there. Of course, Guyana, that's another couple 100,000. And that one is going to continue up and to the right. Brazil.
Has shareholders hope so?
Well, I'll tell you what, the capital's gone that way. So they better put something on the market if they're spending all that money. Brazil up 200,000 barrels a day. Similar trajectory with the Project Q. Canada, 200,000 barrels a day. So right there, we've got 1, 2, 3, 4, 5 countries at 1 to 200,000 barrels a day year-on-year growth. And the big one, bigger than I think people appreciate, is the U.S. at 1.4, 1.5 million barrels a day. Yeah. That's a big number. Not quite the big numbers that we saw in like the 2018, 2019 bonanza when they were kissing 2 million barrels a day, but 1.5 is a big number. Yes. So you split that out, it's 1.5 total liquids, call it 1.1 of crude oil, which itself is still a big number. I thought it worth looking before I kind of tee it back to you here. The U.S. is growing. Where is it growing? It's the Permian, of course. Permian's up 600,000, 700,000, 800,000 barrels a day, depending on what month you're looking at. And you would think that the rest of the U.S. is flat to down. It's really flat. And in fact, you've got a couple of regions poking their heads up with a little bit of growth. And I'm looking at you in the Bakken. They're all of a sudden generating a couple 100,000 barrels a day of growth.
Yeah.
So those are pretty decent numbers. And I would say the momentum suggests that we're not going to drop off the cliff here with production anytime soon either. So this U.S. production profile locked in, and it's going to be strong unless we start seeing some pretty serious rig drops, which we haven't yet in the oil plays.
Yeah, and as we mentioned last week, you did have some surprise supply this year, Venezuela,
Right.
which, everyone, understandably so, and Chevron just took down their year-end or full-year expectations, but it's still much higher than the zero that we had last year, and no one really knew what they were going to walk into, and so everyone kept expectations low, and I think it's certainly come off the peak, but it's well above the bottom. And then we've seen wells out of Gulf of Mexico again, probably our best oil asset here. And one thing that strikes me as you read that out loud, we didn't talk about before the show, but the quality of what comes out. Brazil, Guyana, Sverdrup, we're talking about mid-30s API, technically sour, a lot of these barrels, but we're talking by the skin of its teeth. Mid-double digit type sulfur, very, very good oil. Medium sweets are extremely valuable grades.
So coveted barrels.
Sverdrup is some of the best oil on this planet. And so it's not like for like when you take out, a high 50s API barrel in the U.S. and come back with offshore development like Guyana, those grades are 34, 35 API and really, really nice to have. So there's some high quality oil making its way. Obviously, these OPEC cuts affect lower API. Arab Light tends to live in the low 30s and roughly 2%. It's somewhat similar to Mars in terms of the characteristics you see. But I think that that's a key point in terms of what they're seeing out there is not only oil growth out of shale, but oil growth, quality oil growth, and in a sustainable way out of places like Guyana, Brazil, and in Norway. So I think that it's obviously just like the Federal Reserve and interest rates, OPEC can only control themselves, and they only really have a lever on one side, and that's production. The OSPs are a huge lever, but that's done at the individual country level. Yeah. And so, in terms of the OPEC group itself, and there was obviously tension. The press is going to report what it reports, but the West African nations were clearly unhappy with changes to their baseline. UAE, which has invested in a very IMO 2020 way. They've moved oil to a futures exchange to try to get Murban growing. They've added complexity to their refineries as well as CDU capacity. So now they can take more of their high sulfur, low API oil off the market and send more Murban, which is 35, medium sour, but technically a low sulfur, not technically, but not a very high sulfur sour into the marketplace. So they're itching to reap the rewards of a lot of CapEx come in. So we'll see how that holds going into the year, but into the end of the year. But I think this is the segue into, they are trying to control the market, but they can't control all the growth. And they're struggling with a tough demand picture. And the bulls keep coming back to China, that China's demand is going to grow. There was a lot of things going around last week about Chinese oil demand, and if it's so high, how come oil is here? And that dovetails very nicely into a lot of things we're going to talk about today with difference between oil and liquids. But one thing that I know that you and I have discussed and you were doing some work on, everyone is really, really, really focused on jet fuel demand in China. And I'm not going to sit here and say it's zero, obviously. It's important. But when we look at actual demand and where this goes, it's nothing that can move the needle in excessive amount. And maybe I'm crazy, but how much do you think Chinese jet fuel demand, even if it grows, can really alter the supply-demand picture for oil in the next 6 to 12 months?
Yeah, I wish I had that chart that I'd snipped and sent to you earlier that we got our hair on fire about Chinese air travel. They're flying more domestically, and we're about to get the hockey stick on international. And the grand total of that is like 50 KBD.
Yeah, it's nothing.
We're you and I are here looking at 100, 200,000 barrel a day supply increments dropping on the market, and we're spilling ink over 10, 20, 30 KBD growth range for a China jet. Just, it doesn't matter. I don't mean to be dismissive about jet in general, but of the fuels that we follow on a global basis, jet is the smallest. Yeah, so, absolutely. In a super tight market, it'll be interesting to watch and see how jet contributes to the overall picture. But today, no, I think we're focusing on the wrong things.
I would agree. It really gets a lot of attention. And to ask, for instance, the products demand April 23, the Chinese Bureau of Statistics put out 724,000 barrels a day at Cairo. And to ask 724,000 barrels to carry the weight for the global oil market is, kind of asking the mouse to carry the elephant. It's a little ridiculous. Don't have a reason to doubt that Chinese jet fuel demand will grow. Obviously, we're coming off a COVID zero year, and just over time, consumption will grow. There's a lot of people in China that are going to fly. So it's not, hey, Chinese jet fuel demand is going to zero out. But it just seems to me to be a really tough place to hang your hat. If that's where you want to say demand is going to surprise and demand is going to just be the bull thesis and carry us through the day, that's a tough place to really live, especially when you look at how the Chinese oil market, where the demand is. It's a 4.5 roughly million barrel a day diesel market, not too different from us. It's about a 3.5 million barrel a day gasoline market, obviously much, much smaller than us. Mm-hmm. And then you add in 700,000 barrels of jet fuel. All of a sudden, you're talking, let's just use a round number. It's called a 9 million barrel a day oil products traditional market. And then you have the market out there saying, oh, they buy 15, 16 million barrels. It's a 16 barrel a day market. I'll give them the other 1.5 of fuel oil. And obviously, Singapore is the world's largest bunker market. Asia is a massive bunker fuel market. So that is completely valid. But other than that, we get back to what we're talking about. It's naphthas, it's LPGs, it's other things rather than the full barrel. And so we're asking a place that doesn't need 16 million full barrels to carry the demand for the global market. And I think it's going to be a tough ask. Obviously, it's a lot of people have grown up winning on that since the turn of the century. Now, when in doubt, China bails you out.
Yeah.
And that's worked for commodity investors until it didn't. And, I'm not a bear necessarily on Chinese commodity demand. I don't think it's got to fall apart, but you have to understand what exactly they're consuming. And we're not, and I think part of the reason, like OPEC sees that. And I know that U.S. investors don't like to focus on it, but OPEC knows what's going on there. I mean, it's their customer. It's their most important customer. And so they know where the mismatches are. And they know, Saudi sells propane, Saudi sells ethane, mm-hmm. Saudi sells all these products, as do Enterprise and others. So everyone kind of knows where it is, and the global investing market seems to want to jam it all. And as we said last time, it's really not in that phase right now. So I agree. It's going to be an interesting take. I mean, it's a little too early, I think, right now. I mean, it's late Tuesday morning Eastern as we record this. The cuts were just announced on Sunday. Oil's a little red right now. Cracks are a little green. I don't want to take anything out of current price action and to say that's the reaction of the market. The surprise cut was such a different dynamic. You leave Friday afternoon and then Monday morning, you're forced to react immediately. And so that jams oil up $5. I don't want to say whether these cuts have worked or not or what have you. It's far too early. But I think we're just going to continue to, from my end, and you tell me what you think, I think you just continue to monitor it. I certainly haven't seen any improvement in Asian petchem yet, and nothing to move cracks in a way that would make me go, wow, they're really powering through this. We haven't even had a chance to have a full week, and we haven't had a full DOE data set.
Yeah. No, you're right. And I know you and I, one of our narratives that we always talk about is supply and demand here. And very simplistically, I continue to struggle with the demand implications, the bullish demand implications of removing supply from the market. When you jack up the price for your customer who is struggling right now, I have trouble just understanding how this is bullish for the product that you sell.
I would agree. And naphtha cracks are down $5 since the surprise cut. They're still hanging out between 10 and 11 as of right now. So I don't want to say there's been too much movement since the last, but it certainly is not going to help oil's case if they drive that number further negative. It really is not. And there's nothing yet jumping out of the U.S. to say, hey, diesel demand is going to rip. You know how much of a fan I am of the FreightWaves data. There's nothing they're putting out there that's suggesting that every trucker is in queue to get a full tank of diesel right now. So we'll just have to wait and see. When in doubt, you jam prices up without a commensurate increase in demand. Usually not the best recipe, but energy investors seem to love it. It's definitely a different way to do it, but we'll see how it goes. And again, we are in summer. We are right about to get to the peak of demand. Usually occurs sometime in the July-August frame for gasoline. See how it goes. Let's see how it goes. But I think one thing that we discussed last week that we really wanted to dive into this week and is very relevant, especially for North American energy investors, is the ability of shale to not only respond, but actually capture an oil move. And as we discussed last week, the oil cuts on shale are dropping. They're getting gassier and gassier over time. And I think you and I wanted to spend a little bit more time going into it, because one thing that we see consistently over research from renowned sell-side institutions on social media is, the oil price drives everything. The oil price is how people make their decisions. Why would anyone drop a rig at $70 oil? You're still making plenty of money. And obviously most investors are aware of dry gas, and at least if you're in the energy space, you probably at least have a sense of where Henry Hub is trading, even if you're not focused on the differential market. But there's still just a very broad misunderstanding, I think, of how exposed they are, they meaning the shale and especially the Permian guys, to the NGL market, and how much each day we go on, that NGL market becomes an ever-increasing lever to their cash flows, and how that has affected the ability of these Permian players to capture an oil move. And, it's been the wrong move to think oil is the only thing that matters. Obviously, everyone's been cutting dividends. Everyone's growing debt. So obviously something's wrong. If $70 oil was a Pangea, no one would be having any problems, and we'd still be growing dividends and growing buybacks and playing the game. But clearly that's not happening. So what are some of the things that you were able to find and kind of put pen to paper just to help people realize just how big NGLs are to American energy production, how much they've grown, how big they are relative to the overall market and relative to the amount of oil that we produce here in the U.S.?
Oh man, it's helpful to go and do a long look back, because we live in the moment, right? And I think you and I we're aware of like these trends, but man, they move at a glacial pace. You zoom out, it can get really interesting. So when I started in energy, a sell side analyst had a great quote to me. As I was learning the business, he said, "Oh, energy is a great way to lose money slowly." Well, think about it. When you and I started, we were like the Simmons boat. We were at Hubbard's Peak, right? Just think of it, like how much has changed.
Oh my God, it's insane. It's insane. I mean, I was an analyst on bankruptcies for chemicals companies because gas would pop above $12 all the time. All the time.
Yeah. When I was at Exxon before I left, one of the most coveted projects you could get assigned to was the Golden Pass LNG import terminal, which will be starting up next year as an export terminal.
Absolutely.
Anyway,
All right.
So I'm gonna zoom out for a little bit.
Way back to NG. Yes, let's quote monthly production by month every month since 1928.
You bet. By play, or by play and by state.
By state, yes.
All right. So I'm gonna zoom out. Super high level picture. The NGLs come from gas, right? You take the gas that is, well, it comes from the ground. You strip the NGLs out of the gas. So I started looking at the wet gas production in the U.S. Going to the starting at the pre-shale era. It's round numbers. We went from 50 BCF a day wet gas in the U.S. lower 48. We're at 120 today. Huge growth in wet gas, which we all know about, right? But a lot of that has come from Texas, our big boy, and then the big wedges that have really grown, of course, are Pennsylvania, West Virginia. Mm-hmm. All right. Now, what that has meant, we found a lot of oil, but we found even more gas because every time you're drilling for oil in a shale well, you're still producing gas. It just depends how much. And in round numbers, this is kind of interesting too. You know, the U.S. makes, 12 million barrels a day of oil?
Roughly. In
BOEs, the U.S. is 35 million BOEs a day. When you lump in NGL and gas, that's a lot, right? That's a lot of gas.
Yes, it is. It is. There's a lot of other stuff.
There's a lot of other stuff. And what that has meant, let's say in the shale era, which I'm going to say started in 2011 for at least liquids, the lower 48 has gone from a mid-30s oil cut on total U.S. production down to mid-20s. You've lost 10 percentage points on your oil cut in your aggregate U.S. stream.
Yep.
At the same time, gas and NGLs now are, call it 74, 75% of the stream. So directionally, your exposure to crude has gone down materially while the exposure and sensitivity to gas and NGL has gone up. So with more wet gas means more processing, means more NGL production. And NGL production in the U.S. has gone from 2 million barrels a day to 6. Huge growth.
Huge.
And what's kind of interesting under the blanket there is that the growth in NGL and the growth in processing has meant that you're making more ethane, which you used to reject where you could. So the NGL barrel has gone from 30% to 40% of your total barrel. With ethane being a lighter NGL component, it's lower price. So the actual NGL barrel price as a function of WTI price has gone down.
Yes.
Now we're at, we're going to call it 30-ish% of WTI. When I started it was 40 to 50%. So you've dragged down the price. So you've increased your exposure to a less valuable product across the U.S. And then when this was kind of an interesting exercise, you pretend that the U.S. or the lower 48 is one enormous E&P making 35 million BOEs a day. That production stream on a BOE basis peaked last year, as far as the local highs, it peaked last year at $70 a barrel. So even though crude was well above 100, the blended barrel was selling for $70 a barrel. Today, fast forward 4 quarters, it's been cut in half. The U.S. is realizing $35 a barrel on a BOE basis.
Sounds a lot different than 70, doesn't it?
Yeah, man, because costs have gone up, not down. So what do we do with that, man? You see that the U.S. definitely has more sensitivity to gas and NGL, which is not that appreciated in the market. Where do you look?
Well, and I track an SBI, which tries to encapsulate a lot of that type of work into just one number as to what the BOE is for a Delaware proxy, and then apply something like that to each individual one. But on the shale, you really have to understand who's where, and you have to understand that no matter where you are, that's where you're going to go. It's just a question of when. So everyone likes Midland over Delaware. Well, it's not that Midland is not going in that direction. It's just the wells are smaller and they have a bigger initial oil cut, but the trend is still exactly the same. Delaware does you the disservice of starting near the finish line here. And depending on how farther west you go, you're in a world of hurt from day one, like with Devon and Cimarex or Katera, and many places where COP is, as opposed to doing an equivalent thing in the Delaware. In the Midland. But in terms of where you look where they're made. Roughly when we were going through this, roughly 80% of the NGLs of this country are Pad 3 and Pad 2. And that makes sense. What are the two centers? Mont Belvieu in Texas and One Oak right up in Conway in Kansas. And that's 80%. Then you get another 10% roughly out of Pad 1. Now that Range and Antero and all those guys. And that a lot of that feeds into the MPLX system that is owned by Marathon as they've acquired the fractionators out there. So that's where you're looking. And then the question becomes, who's on the wrong side? Who gets to buy? Who gets to sell? And who's really making money off of this? But I think one of the things that investors need to appreciate when they look at the screen and they look and they say, okay, I see Brent right now in front of me, Brent at 76, I see TI at 72. That's not what your shale guy is making.
Yeah.
At all. And each day that we go on without dropping rigs in the Permian, he's making less of that as a percentage.
That's right.
Because as you said last week, every barrel that comes out devalues your other barrels. And so we're going to continue to kind of flood the market. And I think what you have to do is you have to look and say, all right, who's going to be a winner and loser here? And do I want to own somebody where the rigs, under a scenario where the rigs stay on? And if they stay on, who's got the most negative leverage? Because that means the NGLs of the gas stay on. Yeah. And who am I buying at a high enough multiple or pretending to have a dividend yield? And then all of a sudden I don't realize it. And I go, hey, wait a second, oil's at $80. Why did my earnings go up? And it's like, well, because in a weird way, shale starts to demonstrate a little bit of a negative convexity to oil as oil stays higher for longer because they refuse to drop production. And as you say, it gets harder and harder on the treadmill if only, call it roughly a third of your production in total is oil, to use that to justify all the other things you're doing. And internally, I mean, we really on C3 plus propane up, internally, we really haven't changed demand much in a very, very long time. There hasn't been any real propane demand growth. Everything's about putting this stuff on the water or sticking ethane into petchem demand.
Yes.
And that's it. And so the thing is, like, when can we get more stuff on the water and how much petchem demand can we sustain, which kind of ties into how much overcapacity do we have in Asia on the petchem market? Because that's the place we have petchem growth.
Yeah.
I mean, all roads lead to China. I hate to tell everybody that, but that seems to be the way that this world is going. So, I mean, I don't really know a solution for shale investors right now, because if you're rooting for higher oil, depending on who you are, like if you're Devon or if you're someone in the Delaware, which is just a monster on NGLs, do you want oil to stay at $75? Do you need everybody to kind of calm down, yourself included. You're not blameless here, but you need everybody to take the pedal to the metal. Like Targa and EPD, you need them to stop putting facilities up, but they're going to put them up if people keep the rigs up.
Yeah, and they're going to get paid for them. Yeah.
They're going to get paid for it. So, it becomes sort of a race to the bottom. And I look at shale and I go, okay, everybody, like, you want to cheer an OPEC move, but I don't know if it does you a lot of good. I know what it does for Equinor. I know what it does for Guyana. But I don't really think you have such a direct correlation, especially with the NGL heavy guys.
Yeah, which is a lot of guys now. Yeah, I'd like for you, if you don't mind, to kind of expand upon this, because these are some of the broad numbers that I just hadn't appreciated fully. On the NGL front, U.S., as we've grown NGLs to 6 million barrels a day, our domestic demand has grown from, it ranges seasonally, but it's grown from 1.5 to 2 million barrels a day in the early days pre-shale. And now we're at 3.5. Almost all of which has been ethane. Exactly. Propane's been kind of flat. It's ethane with bringing the ethylene crackers here, right? Building out the capacity here. And our exports, I mean, that hasn't been enough, right? Exports of NGLs in the U.S. have gone from effectively nothing. 10 years ago, it was 300 KBD. Now it's between 2.5 and 3.
Yep.
Most of which is propane, and a growing slug of which is ethane.
Yeah.
And so ethane may be going to Europe, right? But the propane, we're heavy exposure to China again, right?
Yeah, China and India. India is a large buyer of LPG cargoes as well. And it does end up, again, this is all a shift, right? The more propane you spend to Europe, the more naphtha Europe can then send to Asia. So the traders will orbit out depending upon time of year and who's buying what. But ultimately, all roads lead to Southeast Asia.
Right.
And all roads lead to petrochem demand, as well as, like I said, in India, there's been a huge movement to kind of get LPG into the home, to get heating and cooking off of some even more basic stuff like wood and what have you. And so there's been a big movement there. But it's really just getting it to Southeast Asia. And ironically, as we've said last week, and we keep coming back to, that stuff then competes with oil.
Yep.
You can get, there is a small yield when you crack a barrel of oil. Our refineries make about roughly 500 to 600,000 barrels a day, depending on what time of year it is, of propane, propylene. And Enterprise cleans most of that up and purifies it and gets it to polymer grade, and then sells it to Lyondell and the other guys. But what you're doing is kind of creating that whole, as we said, that whole rest of the barrel. There's 75 to 77 million of actual oil demand, and then the rest is part of the barrel competing with other parts of the barrel, competing with other things.
Yeah.
And the more you flood the market with LPGs, the less the need to crack the next barrel of oil to then generate those LPGs. And it really screws up. Look, it's frustrating, right? No one likes when the ground moves beneath their feet at all times. But in energy, it does. You move one piece, by definition, every other piece has to move. So as we have grown those exports, theoretically, that further weakens our oil prices, depending on what part of the cycle we are in. And then it comes down to, well, hopefully we'll just keep having consumption growth, which is why every forecaster comes down to, well, just assume China grows forever, because that's the solve for everything. If I grow China and India forever, then at some point my production is going to be necessary, and then that justifies every long position, which is ultimately the goal of every forecaster, is to justify the long positions that they've gotten their clients into. And so it kind of all works in one way. But I think that it's going to cause a lot of pain, like long term. I mean, EPD has been adamant about this for years, that's the short. They see NGL, and as you look, they have turned themselves into Reilly and NGL company. They're front and center about being the nerve center of the U.S. petchem business. And they view globally that the U.S. is long NGLs, which we are, and the world is short NGLs. And that's true. The top of the barrel has grown, and the middle of the barrel to the bottom of the barrel collectively is flat to shrinking, depending upon how you view it. And so that's where we're going to have to go. The problem is everybody wants to be an oil company, and everyone has an enterprise value based upon revenues of these barrels of oil. And going forward, they're going to have to be LPG companies, and oil is going to have to be, and gas are part of a suite of products, and we're going to have to value them appropriately. And I think you're going to see, as this year goes forward, things like this OPEC cut, if it's like catnip to these Permian guys and they keep their rigs up, this is going to be devastating to these dividend and buyback schemes that are already under pressure from these NGL prices. I mean, we've got just an absolute, it feels like an abyss in front of us right now. We're growing propane inventories at the fastest rate we ever have. They're at the highest seasonal levels they've ever been. There's no end in sight. Your ratios, as you mentioned, the ratios we see are just dropping and dropping. This is a drag now, and the longer these guys pretend to be oil companies and the longer OPEC keeps them going, it might actually even be worse for U.S. investors.
Mm-hmm. Yeah, I think I was messaging you last night as I was looking at consensus numbers, and I was pushing through some numbers on my companies, and I was like, I can't believe some of the estimates here are flat earnings in 2Q versus 1Q, as we've seen gas and NGLs just crater.
Yep.
And, you know, like
absolutely crater.
The average oil company in the U.S. that is considered in the narrative world oily is at best 50% oil, right?
Yep.
And some mix of the remaining 50 is gas and NGL, which have just been obliterated here the last couple of months.
My indicators are all down very hard from Q1. And even with the oil price, the differential keeps growing on my indicators. Last week it was at 32.5. I'm at 33.5 right now as we sit here. So they've already lost another $1 to the oil barrel just from this one OPEC cut. And it's going to keep haunting. It's going to keep haunting. The street's been way too high in their estimates. We just see the earnings go down every quarter. Dividends get cut, but no one wants to give up on this China dream. But I just feel like you're on the wrong horse. It's the wrong way to play it. And I get that it's frustrating if you're a US dollar denominated investor and you have a mandate to stay in USD and you only have so many places you can go. You own Exxon, you own Chevron that at least have some, offshore exposure.
Yeah.
But there's this huge swath of companies that you're almost stuck owning that are just going to, in my view, have a chance to kill you.
Yeah.
Absolutely kill you because you're in an oil company that's not an oil company that is actually demonstrating a declining ability to capture this price. And so, again, we're not a broker-dealer, so you and I aren't putting out buy-sell holds. We're not putting out specific earnings estimates, but hopefully this is helping people with the revenue drivers for their own models. And if you're not including these NGL prices, if you're not modeling these companies on a BOE basis, you may do it and say, you know what, I ran the numbers and I think John and Greg are idiots, which I hear every day from a variety of people. So that's perfectly fine. But if you're ignoring the NGL component of this, and if you are just saying, hey, CL is at 72, that can't be that bad. Well, yeah, it can.
Yeah.
It can.
We make money at 50.
No, yeah, oh God, it's ridiculous. So I think that you have to have a little bit of caveat emptor here. And I've been putting out on my Twitter, I'm a bit of a petchem nerd, and the petchem guys are hurt, man. They're really hurting. The equity market front ran a China recovery and all that. But I mean, if we have a period where not only like we've had these very low prices and almost all of our petchem demand now on ethylene, which is the primary one for consumption, has switched over to ethane. But you still have some from the other components, propane and just the Y grade. But even polypropylene, which has been a much tighter market than ethylene over the past decade, that is in a world of hurt now. And you've got propane that's 35% of WTI, and they're still seeing margin compression because of new capacity that's come on. So we're at a low price. Your dividends have been declining. Your forward cash flows on this current price deck should be much lower and appear to be much lower than the streets out there forecasting. No one's wanted to take the numbers down, especially not in front of an OPEC cutting cycle. Mm-hmm. And the street, what do we always laugh about? There's two numbers that the street always seems to act like fell out of heaven during earnings season, yet are publicly available, and it's crack spreads and NGL prices. It's hysterical watching earnings season. Oh my God, can you believe NGLs? I'm like, yeah, it's a public number. It's not like I have some magic. Any of us have a magic 8-ball where like we're the only ones who are allowed to see it. So if you're looking at this, you're going, man, this is tough. And if we start seeing that petchem market in Asia not react, it's already given back 5 in the last 2 months. If the U.S. petchem market, which all my indicators are turning right now, hard, because that if gas is stable, that was the only thing propping them up. Ethane is tied to gas. The old saying, gas ethane has a floor of gas and a ceiling of propane. Mm-hmm. Propane has a ceiling of ethane and a floor of ethane and a ceiling of oil. The ethane drop was almost 100% of the pop in earnings that we had over the last 2 quarters from petchem.
Yep.
If gas is stable, now the margin degradation story comes back. And if we get a turn down in that sector and they start pushing back what are already cheap inputs. I mean, 20-cent ethane, if we have Westlake and Dow and Lyondell and Exxon and CPK, if they're not hoovering up 20-cent ethane, I mean, how cheap do you want it to be? It costs, depending on where you are, it costs 10 to 15 cents to process it. I mean, there's not much more left. And if they're not hoovering it up and instead push it back, then all of a sudden, I mean, that's really, in my view, I don't know what's going to happen, but that, in my view, is like the downside scenario for the Permian. Is like if Mont Belvieu becomes just a no-fly zone for all these Permian NGLs, then just get out of Dodge, because Eagle Ford to Permian, all these guys that have huge NGL cuts, and then obviously there's stuff at Conway going forward. But in terms of sheer size, Mont Belvieu is so much bigger. That's the problem, and that is staring us in the face, I think, right now. And I'm not sure. Yes, everyone's going to try to exercise patience and say, okay, maybe I can get $100 oil. It's not certain you're going to get to see it, depending on who you are.
Yeah.
There's a lot of dividend and buybacks at risk, and you're trading on supposed yields. Q2 earnings, gas is already done. We've already had the 3 bid weeks for Q2. So Q2 is basically baked for gas, and it's lower. And NGL prices have been terrible, and the forward outlook is terrible. So I don't know. Your first question is, what do you do? I have a tough time telling people, like, oh yeah, this is a good place to go to be long oil. Like, no.
Yeah.
Buy the commodity, or if you can. I don't know if you really want to own oil, I mean, try to buy the commodity if you can, if you're in a seat that allows that.
Or one of the 3 companies that actually has the leverage to oil that the market thinks. Yeah.
Exactly.
I think what's interesting about working in this NGL space, it reminds me a lot of refining, and that there are so many moving pieces, and you got to do a lot of digging to just get a feel for the revenue implications. Like, on an E&P side, it's pretty straightforward. You grab your WTI price and your NG1, and you'll get pretty close, unless you're like in a weird differential or something like that, right? But on NGL, you got to grab all the components. You got to go ethane through propane, and then you got these weird dynamics, like ethane has a different driver than a propane. It's a lot of work, man. It's so much easier to just say, it's 45% WTI and just drag it forward. Yeah. But that's why the surprises keep coming, right? Well, you wake up and you're like, we missed NGLs by $10 a barrel, and it's 30% of this company's production. Like, what happened? Exactly. It's kind of interesting to look year to date on what just hasn't flowed through to the numbers, that January crude was at 80. We're in the low 70s now. So not that shocking. Natural gas came into the year at $4. We're at $2. So that's a huge drop, but I would say it's been appreciated, right? Like, the equities might not have followed it tightly, but this is not a surprise. You're not going to wake up and be surprised to find out that your company got $2 in the second quarter. But on my numbers, NGLs have come from like the low 30s to low 20s, $1 per barrel this year. And that is not in the numbers. I continue to think it's going to shock people.
I agree. When I look at where Q2 is for most of the companies that I track, and I look where the rest of the year is, again, everyone can claim different assumptions, but man, for companies that have 20, 30% NGL cuts, and you've got Q2 growing over Q1 and Q3 growing over Q. And again, nobody on the street, the Wall Street analysts, if you're putting buys and sells on these guys, and you put a sell on any of these guys, and OPEC does a cut and it magically works, and you're the idiot that put a downgrade on something a week before OPEC drove the price up $10, that you're going to get sliced, absolutely cut to shreds. So better to fail as a group than succeed individually on Wall Street. And the analysts are completely going to treat the group this way. And so I'm not surprised that no one's really aggressively gone after things yet.
Yeah.
But
they're going to have to be told.
They're going to have to be told. And again, no one will want to take the first step and say, look, guys, this isn't like a 10% miss. We're like 50% too high.
Yeah.
Yeah. It's not even close. And then you go in the out years, and I see models still where it's like, how are you keeping the oil cut the same?
So that's the separate issue, is like declining the oil cut over time, right? In addition to like mismodeling what is today a huge component of the revenues in NGLs.
Yeah, exactly.
Like I did your standard screen of like of the equities, who has the most percent of their production coming from NGLs. And you've seen these kind of charts before. What's kind of interesting is that all the Permian oil companies, they're 20 to 30% NGL cut.
Yep.
That's a ton of exposure. And this isn't a Waha podcast, but you marry that NGL exposure to the weakest gas realizations in the U.S. and Waha, you were in for some downside surprises for all the Permian guys.
I agree. And obviously I've been bullish on the Marcellus guys in the last month or two. And the Southwest guys have a ton of this exposure, but at least when I look at it, one, they do send some stuff to Europe and Canada, but in general, at least the rest of it is off a low gas number.
Yeah, that people are aware of.
Yeah, exactly. I'm certainly not, blind to the fact that when you look at the Southwestern Marcellus guys, EQT being the exception, it's overwhelmingly dry.
Yeah.
It's except if they close Tug Hill, and even then it's not going to materially move the needle on liquids for them. But, Range, Southwestern, and Taro, they obviously have material NGL components, which obviously, given the price deck, I don't think it's putting out a claim that it's going to suffer. But again, when I look at what the Permian guys have and their expectations and relative to the mix, and then what the dividends that people are expecting out of these Permian guys, no one's really expecting any dividends out of Southwestern PA. They've already beaten the hell out of the stocks.
Yeah.
And as this Permian thing, if this happens and it plays out and rigs drop, they're going to have the actual leverage to that rig drop. And then you get to technical that everybody's already negative on them and short them. So I still feel comfortable, but yeah, I'm not oblivious to the fact that there is NGL pain coming to Southwestern PA, as there is to everybody else.
Yeah.
It's going to happen. Antero puts out their weekly price update. And it's C3 plus. They don't include the C2.
Yeah.
But, you can just pull it up on the website if you don't believe us. The prices are dropping quickly, and are back to kind of early 2022, late 2021 levels.
Yeah.
And here we are only a year plus after the Ukraine invasion. So I think that this is going to be a huge topic. We'll see. I think the refining and the product and the chems market is going to decide if the oil trade falls apart. They're going to decide that pace. And, they'll decide if that happens in a month, in a week, in 6 months, what have you. But the NGL market, the U.S. petchem and all those things, as we oversupply it, that frac spread on propane just collapsed last week. And so that appears to be the place where the downside movement is happening.
Yeah.
In the fastest manner. We had a bump up in absolute prices yesterday. Oil was up. Everyone's bidding everything. I'm not going to say prices are now recovered because of one day, and I'm also not going to say they can't. But if you look right now, what's the biggest risk to you as a U.S. energy investor? What's moving the most quickly against you? It's NGL.
Yeah.
And I, as to your point, after reading those stats about the size of that market, there still is not an equivalent amount of appreciation, in my view, to the size of the impact that has on your numbers. And it caveat emptor. And if anyone's got a portfolio of shale stocks that they are watching casually, or don't have at the tip of their tongue, like how much am I NGL exposed with this basket of stocks or one particular stock or what have you, get yourself up to speed on it. Because that's really going to be, in my view, look, anything can turn around. But if you want to say what's going to bite me the soonest, as of right now, the horse that's in the lead is NGLs.
Yeah, I was going through this exercise recently on the cash flow sensitivity, not the revenue sensitivity, right? Like, because we know that Antero and Range in particular, they're big NGL producers, they're going to have revenue sensitivity. But by virtue of being gas producers, their cost structure on a unit basis is lower than the oil peers. So when you look at like the corporate level, though, the cash flow impact, you see the guys who are making more NGLs than the market appreciates and are burdened with higher cost structures, usually from being crappy operators or having crappy assets. There's some names that shake out as really sensitive that you wouldn't expect. And it's Permian guys, it's the combo guys. So you're talking on my numbers, like between 1%, 2%, 3% cash flow hit from every dollar drop in NGL prices, which have tumbled here. And that's just on the NGL side.
Yeah. And when you're talking, depending on how you shape the index and how you weight everything, $15 to $25 bet per BOE drops. And then unlike the Marcellus guys, the CapEx programs in the Permian are still huge.
Yes.
So
yeah, great point.
After you take those cash flows from ops, that's the sensitivity. You subtract a lot less in the Marcellus. They're not drilling. You subtract a lot in the Permian. So when I've run that sensitivity, I take the CapEx out, and then you add in the laugh of the dividend and the buyback, and then it becomes preposterous.
Yeah.
And to the point where when you look at what CFOs are saying, and Wall Street will always parrot the CFOs and the CEOs, I know they know better, and I know the CEO, this is not going to be a high horse thing, but like the CEOs and the CFOs, their job is to keep their stock price up. But to get out there and say only the oil price matters, they know the math. They know the math. I mean, I don't care if you're a believer or not. If you are a management level guy at a major U.S. shale player, you know the math. And to sit there and watch your propane collapse and your ethane collapse, and you know what your processing fees are that you're getting charged by EPD or Targa, you know what the after-tax net is, you know how much money you made in 2022, and you're watching it evaporate and go lower, and to publicly say, oh, only the oil matters. Again, I know I'm not naive. I know everyone's got to try to keep their stock price up, but come on. There are certain folks that don't do the math on this, that, I know this is capitalist society. We're all supposed to do our own work, but come on, just at least admit that this is, if you've cut your dividend 3 quarters in a row, don't tell me that, oh, it's only because of oil. And we now have guys that have cut their dividend 3 quarters in a row. They're going to do it 4, unless we have the most wild 24 remaining days of June we've ever seen. And who knows? I mean, who knows? There are warships near Taiwan and, Ukraine. They just broke a dam and they're blowing up. I mean, who knows? I'm not a geopolitical expert, but the math at the end of the quarter is really tough to overcome. And we're already more than 2/3 through the quarter. Yeah. So you're gonna, barring a huge change, you're gonna have lower revenues, lower cash flows, therefore lower variable dividends, if any. And the share buyback is going to continue to put stress on your balance sheet. You're probably going to grow your debt balance. Yeah. So don't go out there and say, hey, by the way, not only we're going to say that, no, we're going to make all the Wall Street guys that cover our stocks say that. Like, stop saying it, And it's like at some point, this will once again be the undoing of Shale 3.0. I know we were joking the other day, like, who won Shale 3.0? It's like, oh, the PE guys. The PE guys won. They tagged Devon again. They tagged everybody. PXD had a bunch of guys. They had to they put rigs up. They played poker. They said, well, you guys are pitching this to Wall Street. We know it's BS. We're going to drill our brains out and you're going to buy us. And they did.
And it worked. Yeah.
They're sitting there laughing their what's off. And they won. And the public equity shareholders, once again, in this space appear to be holding the bag, and now you're kind of hoping. It's kind of funny. You laugh at all these folks from Canada and Texas that on social media, obviously a relative political view is very prevalent in the oil industry. And I'm not taking any political stance on anything, but it's kind of funny to watch people with that political stance. And then every 60 days, they turn into teenage girls fanboying for a K-pop band when it comes to OPEC ministers, and they're posting photos and they're fawning over these guys. Meanwhile, 48 days later, it's, here I'm in my Ford F-150 listening to Toby Keith. It's hysterical to watch that what's kind of happened in this business over the last couple years in terms of how it's all gone. So, this I would argue right now, highest probability Shale 3.0 is undone by this NGL situation we have right now.
So I've got a budding thesis. Now the space has not done well since the highs of last year, but the beauty of this shareholder return model is that it's based on backwards looking cash flows, right? So they take the prior quarter's cash flows and then they declare your forward quarter's return schedule. Mm-hmm. And that's made the math relatively easy, but it still seems to take the market by surprise when the returns keep getting cut, the variable dividends. So yes. I think that the 3Q declarations that are going to come out with 2Q earnings are going to completely gobsmack the market. I'm looking at numbers here where they're going to get cut way more than half on some of your bigger producers. You're going to lose your variables, you're going to lose your buyback or something. Your shareholder returns of 3Q are going down huge relative to 2Q. And on the range of companies I've looked at, you're down 70, 80+% from your 2Q highs. That whole, we're in perpetual free cash flow and returning it. We got a 15% yield and the S&P's at 2%. It's going to be just obliterated. And I think it's going to scare the market because at the same time, there are two cardinal sins in E&P: outspending cash flows and building debt, right? And as I was showing you this morning, when I start projecting out here, I've got some of these mega producers are adding billions of dollars of debt since the summer of 22. This one, I don't think it's been appreciated at all. They're adding debt and over returning cash flow. This whole thing is broken.
Yes. All right. Well, listen, I think you're right. This is going to be a very interesting earnings season. We'll see how disappointed people are and if it's time for heading for the exits. But again, everyone kind of hangs on to the bitter end. So maybe everything trades up. I mean, it could definitely trade up into this with some crazier things. And so maybe we have a really big vacuum higher into what, as of now, looks like a very disappointing earnings and cash flow picture. And if this capital return story is what you're in there for or what you promised your investors, it's definitely appears to be going the other way. All right. Well, listen, I hope that was helpful for everybody. I'm John Reilly with Greg Bordelon. This has been the Diff on the Primary Vision Network. Thank you very much for your time. Please like or subscribe to Primary Vision Network. I can be reached at Ovington AM on Twitter. And please feel free to put anything in the comments and reach out. We'd love to hear from you. Thanks again.